Hi, welcome back to the channel. Hope everybody's doing well. I usually do a monthly video ticking off the portfolio moves, the buys and the sells and what's going on. But if there's anything noticeable been happening, I'll be sure to roll out these sort of mini updates, just going over the companies that I've picked up, why I've picked them up and what I think about them, and more so why I bought the company at these prices given here. So these are the two new holdings within the portfolio. Each offer something totally different. We've got Coupang, who are a South Korean e-commerce company. They're seen as the Amazon answer in South Korea. They're currently loss making, they aren't making any profits, got high revenue growth in the future. They've got a CEO who I think really has a bit about him. I like the sound of him, I like the look of him. I think he is very innovative out there. The company's only been around since 2010 and it's performing exceedingly well in regards to getting a piece of the market share, which we'll tick off in just a little moment. I've picked up 119 shares at just under $27, which is right around their IPO price they were planning to kick off at. But the share price, since it has IPO'd, has came right down. It's came down close to 50%. There has been a bit of controversy regarding the stock, surrounding that someone unfortunately lost their life in a fire in one of the logistical centres, and there's also been questions asked about their safety and the labour workforce practices. The articles that I've just mentioned there are hard to hear about. Certainly don't want to hear about anybody losing their life at a place of work. But the company here, Coupang, it's out of favour. Wall Street isn't quite grasping it yet, and I think over the long run, I can see me getting 100% out of this, certainly over the next 5 years. So fingers crossed. But the second stock offers something totally different. This is more of a safe haven. It's a large pharma company sitting right now at 52-week lows, and as soon as I see a value stock like that sitting at 52-week lows, it perks up my ears. And these two companies, by the way, these have been on two different series or two different episodes of the 3 stocks to buy earlier on in the year, which I'll fire these up at the top just now. And if you want to check out more about these companies, feel free to go back and have a look through the videos. But Amgen, I picked up 15 shares at about $205. I seen it was coming down. I'll be totally honest, I was hoping that it was going to go below $200. I was looking to get it about the 190 mark, but I didn't want to price myself out of opening this initial position. So we picked it up at $205. Not going to lose sleep over that. We've got £2,250 invested in it, and the company pays a very nice dividend, about 3.5%. So we'll go a little dive deeper into these companies and why I picked them up at these given prices. Firstly, if we just go through some of the South Korean e-commerce market forecasts, facts and figures, we've got here an outlook from 2017 out to 2025, and you can see the robust growth that's expected within this market. And this just isn't South Korea. You'll get these same sort of figures across the board. And if we look over to the right hand side, we've got the average revenue per customer. You can see that the customers are spending more as time progresses, and you just know that e-commerce is a trend which is going to be here to stay for a long time into the future. The South Korean e-commerce market is developed, but there's still plenty of legroom here for future growth drivers. Right now, 2021, they are expecting that the market is sitting at around a 25% penetration rate. So you've still got plenty of room there for future growth, and as they expect on out to 2025, they expect it to be sitting at about an 83% penetration rate then. If we look at Coupang's market share, as I mentioned, it's a new company. They've been kicking around since 2010, so the company's only 11 years old. They're in a highly competitive market, and they've got close to 14% market share. If we compare that to the company above them, Naver, they've been around since 1999, and they're sitting with a market share of close to 19%. So the fact that Coupang are the new kids on the block, and they've got close to 14% market share, I see this as a really positive indicator that their brand's doing well, the company's a high performance, and who knows, they might be able to take up more market share. And with the growth forecast out to 2025, I can only see revenue going in the one direction. And the last point about e-commerce, if we look at companies over a long period of time, if we look at Amazon here, well, there's no further description needed. Amazon has been a huge winner over a long period of time. Then if we start to look at other companies, we look at Mercado Libre alongside C. These two companies, sometimes the share price has been stagnant. It hasn't quite moved. It's been up and down a little bit. It's been consolidating for long periods of time. But when Wall Street really get a hold of it, it takes off. And I feel that Coupang has a bit to offer in the same regard here. The share price right now, down almost 50% from IPO. So for me, I think it offers a good risk reward play, and I'm excited to see how this one turns out in the long run. Second company I've got a brand new holder in is Amgen, large pharma company, 117 billion market cap, offering a really tasty 3.4% dividend yield. I like the look of them, more of a safe company. Of course, the share price can certainly go down as it's sitting at 52-week lows, and history isn't a method of future performance, but in general, the company has a really diverse therapy portfolio. I believe in the company's long-term strategies, and looking at the share chart over the last 5 years, anytime there's been any long periods of underperformance over a long period of time, it does seem to recover and go in the correct way that we're looking for. So I'm happy to open up this initial position, get that nice 3.4% dividend yield, and we'll see where the share price takes us in the coming months and years ahead. Performance wise, the company's revenue has been quite flat over the last few years. Look at that in two ways. We look at it in a positive way. We know that the company has a reliable revenue source, and if we look at it as a glass half empty, then we can look at it that to say, where's the growth coming from here? You want to see the revenue ticking up and to the right as time progresses. However, earnings per share, that paints a good picture. A bit artificially, if I do say so, as Amgen have been buying back shares, so even if revenue is flat as it has been in some occasions, if they start to buy back shares, this can artificially kind of give you more earnings per share. But aside from that, the company itself, I believe in the products, I believe in the portfolio, I do believe in the company's long-term prospects. Valuation perspective, looking at the 5-year dividend yield of where it's been sitting, it's sitting at the highest point it has done over the last 5 years. This goes hand in hand with it's sitting at 52-week lows in regards to its current share price. The dividend yield is 3.4%, payout ratio 43%, it's had a 5-year growth rate about 12.5%, and it's only 1 year away from being a dividend contender. Dividend contender being a company which has paid a continuous constant dividend of up to 10 years, so that's very close to entering that. That's very close to getting that contender title. There has been good news and bad news within the company. 5.2% year over year. It beat analyst expectations. They bought back shares, so everything sounded great. But on the right hand side, and this is the exact same date where on the share chart on the 3rd of August, if you see, that's where it topped out and the share prices came tumbling down, where they did lower their earnings guidance. So they gave a revenue beat. Their earnings for that quarter were bang on the money, if not exceeded. But as we know, the stock market's always looking forward, and the forward guidance didn't quite meet up to what analysts were expecting. And this has given a close to 20% sell-off in the share price, which in my opinion isn't justified. And this section here is taken from the latest 10Q, where it gives a breakdown of all the top performing drugs on how they've been performing. And the sections that I've got highlighted, and this is because the majority of the revenue comes from their other products, not from all their best sellers, their top known drugs. It's from all their smaller little products that they've got out there. And I like this because this has an element of safety. It means that they don't have one or two drugs that generates mass amounts of revenue. When the patency gets expired, then they're going to lose all this revenue. All the other small products keep chipping away and they keep these revenues consistent. And I see that as a bullish indicator rather than a negative indicator, as they do have other drugs in their pipeline which could lead to future growth. This is one of the latest drugs which just came into the market. It's just been FDA approved, and the growth forecasts out to 2026 are expected to exceed $2 billion. The drug's called Lumakras, and it's a real breakthrough drug in the sense that it's the first in class and it treats non-small cell lung cancer. So this is the drug here. Feel free to have a little read through this article. It gives it in a little more detail how this therapy helps, and it could be a good growth driver for the company going forward. Earnings season is kicking off, and I've got two companies which released earnings this week. These are the positions within the portfolio. We've got Walgreens Boots Alliance, currently up close to 15%, and we've got Wells Fargo, which has been a real standout for me just now, close to being up 50% from the position invested. Earnings just came out, and this earnings season is going to be a really important one, as we're going to get feedback from companies out there on how they're getting on with supply chain issues. So let's go into these two companies and see what they're saying regarding their growth strategies and current results. Wells Fargo, alongside the majority of the financial sector, beat on both top and bottom lines, real strong performers. The consumer banking and lending seems to be really strong out there. So if we just go through some of the key points. Revenue is down 2.4% year over year, but it beat analyst expectations with $520 million, and they also beat on earnings per share. So real strong performance from the banking sector, and more individually here for Wells Fargo. Looking at the different metrics on the right hand side, you can see that the majority of the metrics were real strong performers. Consumer banking and lending was up. Commercial banking did take a little dip. You've got corporate investment banking up, wealth investment management up, loans up, deposits up, Q3 provisioning for credit loss was up, net interest income was up, and non-interest income was down. But overall, really positive results for Wells Fargo, and really delighted to have them in the portfolio. And you can see we're up at 50%, so not a lot to say here. A long may it continue. I think that financials will continue to perform well in this higher rate environment which we're about to progress into. The second stock that we've got here is Walgreens Boots Alliance, also released earnings, and pretty positive, I must say. They beat again, revenue been pretty steady, 34.26 billion, down just under 1.5%, but it did beat analyst expectations of close to $1 billion. They beat on non-GAAP EPS, but their GAAP EPS did miss by 42 cents. The CEO, they've got a new CEO, Roz Brewer, who's in. She's come from Starbucks, and she's making moves. On the right hand side, if you look here, Walgreens doubles its stake investment in Village MD with a $2.5 billion investment, and this increases their ownership stake from 30% up to 63%. They are currently an independent company, and as it says there, they're expected to IPO in 2022. You may be asking, who are Village MD if you haven't heard of them before? They are a major provider of value-based primary care throughout the US, and they're strategically located the majority of times next to a Walgreens pharmacy, and it gives that strategic location as these two services work hand in hand with each other. And you can see that Roz, the CEO, fully believes within this vision and has doubled down within the strategy, and I totally believe that. I think healthcare and primary healthcare solutions and services through different metrics are going to be a real growth driver for Walgreens. And Walgreens really has been a dog in the Dow. It's been up at highs at $80 per share in years gone by, and it's just been plummeting ever since. And with these sort of moves into the healthcare side of things, and a different avenue just being a drugstore, I see this as a real positive indicator and bullish behind the company. The share price has also been showing the optimism behind the CEO Roz's outlines. As I mentioned, the outlines plan to make healthcare its growth engine. The company plans to open hundreds of doctors' offices, offer in-store consultations with nurses and pharmacists. So that'll pretty much sum up the video. I hope you've enjoyed it. Just to give I just wanted to share my thoughts on some of the companies that I've been buying and provide a little update on what's been happening on some of the existing holdings. So thanks again for watching, and I'll catch up with you guys in the next update. Thank you.